In 1998, the smartest fund on earth went broke in weeks. Two of its partners had just won the Nobel Prize. They had built a machine that supposedly could not lose. Then it lost $4 billion in 4 short months. By the end here, you will know the one error, the error that wipes out even certified geniuses, and the value rule that would have saved them all. The fund was named Long-Term Capital Management. It launched in 1994 from a quiet Connecticut town. The founder was John Merriweather, a legend from Salomon Brothers. He had run the most profitable bond desk on Wall Street. He recruited the finest mathematical minds money could buy. Two of them were Myron Scholes and Robert Merton. They had written the formula that prices every option. In 1997, that formula won them the Nobel in economics. Imagine the confidence in that single Connecticut room. Nobel laureates, star traders, and the best models alive. Investors begged to hand them money. Many were turned away. The minimum buy-in was $10 million, locked for years. Banks lent to them at rates reserved for governments. The strategy itself was elegant and genuinely brilliant. They hunted tiny price gaps between nearly identical bonds, two bonds that should cost the same but briefly did not. They bought the cheap one and sold the dear one short. When the prices converged, they pocketed the gap. The gaps were absurdly small, pennies on the dollar. A few cents of profit on a safe, boring trade. So how do pennies build a multi-billion-dollar fund? This is where the whole story quietly turns dangerous. The answer was leverage. Enormous, breathtaking leverage. Leverage means trading with money you have borrowed. Picture buying a house with a tiny down payment. You control the whole house for a sliver of the price. If the house rises 10%, your stake can double. That is the seductive magic of borrowed money. LTCM did this on a scale never seen before. For every dollar they owned, they borrowed about 30. Their own capital was roughly $4 billion. Their borrowed positions reached over $100 billion. And their hidden derivative bets touched $1 trillion. 30 to 1, leverage turns a whisper into a scream. A 1% gain on the trades became 30%. So tiny gaps multiplied 30 times became huge profits. In year 1, the fund returned over 20%. In year 2, it returned over 40%. Investors felt like they had discovered free money. The partners reinvested their own fortunes right alongside. Here is the somatic part. Feel your own pulse quicken. Imagine your wealth doubling while you sleep each night. That warm, certain feeling is exactly the trap, because the model assumed the future would behave. It assumed prices move in smooth, predictable waves. It assumed history was a reliable guide to tomorrow. It assumed markets would never all panic at once. Those assumptions held for decades until they didn't. Graham warned about exactly this kind of certainty. Mr. Market, Graham wrote, is moody and irrational. Some days he is euphoric, some days he is terrified. A wise investor never assumes he will stay calm, but the models in Connecticut assumed permanent calm. Then in August 1998, the storm finally arrived. Far away, Russia did the unthinkable to its own debt. The Russian government simply defaulted and refused to pay. A nation walking away from its own bonds was unheard of. The model had rated that outcome essentially impossible. Around the world, frightened investors did one thing. They dumped everything risky and fled to safety. Every bond LTCM had bet against suddenly soared. Every bond LTCM had bet on suddenly collapsed. The gaps they traded did not converge. They exploded. Their elegant trades all went wrong on the same day. And remember, every position was leveraged 30 times, so a small loss became a catastrophic one instantly. In a single August day, they lost $550 million. Picture the silence in that Connecticut trading room. The phones rang. The lenders wanted their money back. This is the moment every leveraged investor dreads. It is called a margin call, and it is merciless. When you trade on borrowed money, the lender sets terms. If your bet drops, they demand more cash at once. Not next week, not tomorrow. Today, in full. If you cannot pay, they sell your positions for you, and they sell into the worst possible market. LTCM was brilliant, but it had almost no spare cash. Every dollar was already committed to another trade. They had no margin of safety, none whatsoever. This is the exact phrase Graham built his career on. Margin of safety means buying with room to be wrong. You pay 50 cents for a dollar of real value, so even if you misjudge, the gap protects you. LTCM had paid nearly full price and borrowed the rest. They left themselves no room for error at all. So when the world surprised them, there was no buffer. This is the heart of the lesson. Listen closely. You can be completely right and still get wiped out. Their trades, given enough time, were actually correct. The gaps did eventually converge years later. But LTCM did not have years, it had days. Leverage stole their most precious asset, which was time. Borrowed money does not let you wait out a storm. The lender's clock runs faster than your thesis. So being right too early is the same as being wrong. By September, their capital had nearly evaporated. $4 billion dwindled toward a few hundred million, and here the private failure became a public danger. LTCM owed money to nearly every major bank on earth. If it collapsed, it could drag the banks down with it. One falling firm could pull the whole system off the cliff. This is what economists fearfully call systemic risk. The Federal Reserve in New York watched with alarm. They feared a chain reaction across the whole economy. So the central bank summoned the heads of Wall Street. 16 rival banks gathered in one tense room. Their old competitors now had to rescue the geniuses. They assembled a bailout of over $3 billion. The banks took over the fund to unwind it slowly. There was no government money. The banks paid themselves. They did it to save themselves, not the partners. The Nobel laureates lost almost their entire fortunes. Merriweather's investors saw their stakes nearly vanish. The smartest fund in history was quietly buried. So what does a value investor take from this wreck? First, leverage turns a small mistake into a fatal one. Without debt, a bad bet simply costs you that bet. With debt, a bad bet can cost you absolutely everything. Buffett said it plainly after watching LTCM fall. To make money they didn't have, they risked what they did. That sentence is worth reading slowly more than once. Second, your model is only as good as its assumptions. The map is never the same thing as the road. Markets are run by frightened, hopeful human beings, and frightened people do not obey tidy equations. Third and most important, demand a margin of safety. Never pay so much that being wrong destroys you. Always leave room for the future to surprise you. Buy the dollar for 50 cents and keep cash ready. The cushion is boring and the cushion is everything. LTCM had genius models and Nobel medals in hand. What it did not have was a single inch of cushion. And the market only needs one bad month to ask. Remember, the smartest men in finance broke in weeks. They were right about the trades and still lost it all because leverage took away their time to be right. Protect your time. Protect your downside. Stay solvent. The investor who survives the storm wins by default. Survival is the first rule. Everything else is second. So before any trade, ask the question they forgot. What happens to me if I'm completely wrong? If the honest answer is ruin, you walk away. That discipline is duller than genius, and it lasts. Genius built the fund. Discipline would have saved it. Next time we cover how Buffett uses borrowed float safely. If this was useful, subscribe and watch that one next.